So look, as much as we'd all like it to be true, the stock market isn't rising at all times. But that doesn't mean that we can't still bring in income during those neutral and declining markets. So today we're going to talk about exactly how to do that. My name is Charlie, and on this channel I make videos about wealth building and financial freedom so that you can free up your time to focus on the things that you truly care about. So if you've seen my previous videos, you know that my primary strategy in the stock market is covered call writing, and I use that strategy to bring in income under all market conditions. But critics of the strategy will say, well, what if your stock drops in price and then you can no longer bring in any decent premiums?
What are you gonna do then, huh? Punk? What are you gonna do?
Well, let me tell you right now that if you set up your covered calls properly and you choose the right stocks, you're not going to end up in that situation. So let's talk about choosing the right stocks. As I always say, the most important thing is to pick stocks that you believe in for the long term, so that way even if the market as a whole drops, you can have some peace of mind knowing that the fundamentals of your companies haven't changed and they're going to recover eventually. Which is nice and all, but you can't buy things using peace of mind, so how does this actually help us bring in more income? Well, if you're choosing solid companies that pay a dividend and or are included in a major index like the Dow Jones Industrial Average, those stocks tend to drop a lot less in value during adverse market conditions when compared to more volatile stocks that don't pay a dividend. So because of that, the covered calls you're selling won't have to be as far out of the money, and therefore you'll be bringing in bigger premiums. And also, if you're holding stocks that pay dividends, you'll be collecting those dividend payments all along the way, which provides another little source of income as well. So now, assuming you're choosing solid stocks and you've got all the other basics in check, let's talk about how the actual covered call strategy changes during neutral and declining markets. And of course, when it comes to covered calls, the only two variables you can really change are the strike price and the expiration date that you choose. So in more neutral or slightly declining markets like we've seen throughout most of October and into November 2020 here, you'll want to sell longer dated calls, more like 3 to 5 weeks out, in order to lock in a bigger premium. That way, regardless of what happens from now until the expiration of that call, you've already locked in that bigger premium, so you don't really have to worry about it. So let's go ahead and look at Microsoft stock to see how this might play out. Now, I happen to own some shares at a higher cost basis, around $215 here, right before it started to pull back through the end of October. Now, whenever I sell these longer dated calls, I usually sell them at least $5 out of the money, so that way in case I'm wrong and the stock does rise quickly over the next few weeks, I can still bring in some of those capital gains. But in my case, since I bought Microsoft around $215, I'm going to look for calls around that price so that I don't have any chance of selling my stock at a loss. So today is November 2nd, and we can see that about 30 days out at the December 4th 215 strike, a full $12 out of the money, I can bring in a premium of $3.50, which is about a 1.6% return over the course of the month. So that doesn't sound huge, but that's assuming the stock doesn't rise at all over the next month, and since it's a stock we believe in for the long term, we do expect it to recover soon enough. And that's also sort of a worst case scenario because the stock dropped quite a bit after we bought it. But if we were to buy Microsoft at the current price, around $202.30, and we predict that the market will stay neutral over the next month, we can sell the 207.50 strike call 30 days out for a premium of $6.05, and that still leaves us with about a potential $500 of capital gains in the case that the stock does actually rise. So in that case, you'd be bringing in a return of anywhere from 3 to 5.5% over the course of the month, even in a pretty neutral market. So the moral of the story is that when you're picking a strike price and expiration date, you really have to think about what are your expectations for the market over the next month, and then use that to make your decision. Now, you might also be thinking, well, nobody can predict what's going to happen with the market, so how do we actually know when to start selling these longer dated calls? And you're right that we can never exactly predict where the market is going to go, but you can still look at trends and overall market conditions to get a general idea of what to expect. For example, certain months of the year tend to be more volatile than others. October, for example, tends to be the most volatile, and in certain months, stocks tend not to rise as much, like in August and September. Then historically, in November through December, stocks tend to rise again. And aside from these seasonal trends, there are also, of course, always events happening in the world that cause movement in the stock market. For example, if there were to hypothetically be a big presidential election coming up that people were nervous about, or if there were some sort of virus going around causing businesses all over the world to shut down. And I know that's pretty unlikely to happen, but you never know, it could happen. But despite all of that, it's true that it's impossible to know exactly what's going to happen with the market in the short term, so it's always a good idea to use these longer dated calls as part of a balanced strategy alongside your usual shorter dated calls. So now that you know how to trade covered calls in a neutral or declining market, if you want to see how I pick stocks for covered call writing, be sure to click that video in the bottom right corner of the screen. So there you go. I'll talk to you all in the next one.